In your money news this midday, as prices continue to rise and wallets are pinched a bit, many people are fearful that we could actually end up in a recession. Stuart Fields, a local financial professional from Open Air Advisors, joins us now to share more about the current economic climate and really help us prepare for what the future may hold for us. Thanks for joining us this midday.
Thank you. Glad to be here.
Yes. All right. Now, what are some signs of a recession that we should probably be looking out for?
A traditional recession is actually measured by 2 consecutive losses in GDP. And in fact, in the first quarter, we saw GDP decline about 1.4%.
Okay.
So with that, as we see inflation still about 40-year highs, with CPI, or Consumer Price Index, about 8.5%. So definitely the Fed is in action. They've raised rates 2 times already this year. The last time they raised hikes was 0.5 percentage point, which is the largest hike they've had in the last 22 years.
Now, I'm sure you finance experts are talking to each other. Is it likely that we could potentially see a recession, and when could that potentially happen? Well,
about 81% of Americans think that a recession is going to happen within the next 2 years. Well, yes, whereas only 40% of economists think that a recession is likely in the next 2 years. So there is some hope. We do see some good figures coming out. One of those facts is that unemployment rate is about 3.6%. Okay. So that's actually what the Fed considers full employment. The second thing we've seen is since March of 2021, hourly wages have gone up 5.6%. And third, consumer spending is on the rise. We've seen 3 consecutive quarters of rising consumer spending. So that's also a good positive sign. So we're getting some mixed signals.
Yeah, mixed signals, okay.
But even with that, most economists think there's still about a 50-50 chance that we could go into some sort of recession within the next 2 years.
So how should we prepare? How should we be ready for this?
Well, first of all, I think you should diversify your assets. Right now, what you did 5-10 years ago is definitely not the way forward. So you definitely need to have correct exposure to the appropriate asset classes.
Okay.
So this is an excellent time to review your plan, stress test your portfolio. If the market would go down another 5, 10, 15%, what would happen? And once you have answers to those questions, you can make better decisions going forward.
Right.
And for those people that are in retirement or nearing retirement, well, they're taking distributions from their portfolios. So what you need to look at is within the next 6 to 12 months is where those distributions will come from. Because what you do with those plans is different than the rest of your portfolio, because you definitely don't want to combine big losses with large distributions from your retirement assets.
Let's talk about boosting your emergency savings rather. How do you do that when things cost more? I mean, times are hard for some families.
Yeah, this is a good time to do so. With wages on the rise a little bit, and with a lot of people predicting a recession in the future, this is a good time to boost those savings. We definitely recommend between about 3 to 6 months of savings. Okay. So if you do lose your job or you miss a paycheck, you've got something to go towards in that meantime. And during a recession, many companies are pretty quick to lay off their workforce. So this is a great time to go ahead and boost that. If you're not at 3 to 6 months levels already, go ahead and get there right now.
Now, I've spoke to a few people that are on the brink of retiring, and they're scared, wondering, wait, is this the right time to retire?
So you have to remain calm.
What's your advice to them?
Exactly. Remain calm. You know, if we did go into a recession, it's going to be a little bit different than we saw in 2008, which was caused by a financial downturn, financial crisis. Here, what we're seeing is basically because bank balance sheets are very strong, in the tunes of about $7.1 trillion. So again, if we did go to a downturn, we're thinking that it would be much more short-lived than last time that we saw in 2008.
All right, Stuart, thank you so much for joining us. Great advice, great insight there too. Remain calm. I'll try to remember that.
Exactly.
All right, let's talk weather.